Okay, so Dave, we're talking about the state of the financial market. From COVID to today, what the heck happened?
What the heck? I'm sure there's other words you might want to use. What the?
Why did things change so much?
Yeah, well, I mean, COVID was a big brick in the face to the economy, right? And I think, what even lended to that even more is that there was so much uncertainty. It was kind of unprecedented, right? So the market—
That was the word for a year and a half, unprecedented.
Unprecedented. Well, it really was. So, I mean, like when you think about it, when something is truly unprecedented, what sort of policy you take to try and get in front of things, like you're kind of like throwing the dice in Vegas, right? To a certain point. And, there was two very like staunchly different views on what was going down, and one direction was the current administration at the time, and certain choices were made. But look, when COVID hit in early 2020, there was the immediate perception that this was going to like take down the economy, right? Job unemployment went absolutely nuts.
The sky is falling. The sky is falling.
Stay-at-home orders, right? Like we just really didn't know how things were going to shake down. So like in as early as March, which was right like on the onset, right? My kiddo was born on February 12th. Right when COVID was starting, like literally, we unfortunately had to go to the NICU for a little bit. And like while he was in the NICU, when I got out, like I went to the store to like get some things for my kids, and there was like nothing on the shelf. It all literally went down like while we were in the hospital.
The toilet paper, the eggs.
Crazy. So the market responded hugely in two major ways.
Talk to me.
The first is the Federal Reserve came in March and literally cut interest rates to zero, right? Now, we're not talking about mortgage interest rates, right? There's an important
clarify that, because people always get that confused.
Yeah, you bet. And sometimes they work conversely to each other, which makes it even more confusing. People call me like, hey, I heard rates went down. And
I literally had that conversation with somebody a week ago.
Yeah. So when you hear the Fed talking about interest rates and them being able to utilize that as a tool to kind of dictate how the strength of the economy is going, they're talking about the Fed rate, or the federal overnight lending rate. So if you're Bank of America, this is your cost to borrowing money, right? So you borrow money at 2%, and then you loan me money at 4% as a consumer. Well, the difference is what you make. They're not a nonprofit, Catherine, believe it or not. They make tons of money. they like it too. The bankers, they like making money. But so they cut the overnight lending rate down to zero, which really inspired banking institutions to lend. We saw it in auto loan interest rates. We saw it in credit card interest rates. And although mortgages are not entirely tied to that federal, it still lends to the general direction of interest rates. So mortgage interest rates crashed. The second component was, when we do loans for people, right, we don't like walk to a vault, open it up, and like take out a big bag of money and then send it to the escrow company. This money is all hedged. It's borrowed. We're talking Wall Street. This is big money. And then these loans are put together in what we call mortgage-backed securities, and they're sold. They're sold to private investors. They're sold to life insurance companies. They're sold to other countries, right? So the government stepped up and said, hey, mortgage lenders out there, don't worry. We will step up and be your biggest buyer. And it's a term you may have heard of called quantitative easement, where the government stepped up and said, we will commit to a package of over $700 billion of purchasing this. So when you're a mortgage company and you're like, Uncle Sam is going to take this off our books, it's very reassuring.
Yes.
Right? So what happens to the risk of that loan? Goes down.
Yep.
And interest rates are really just a reflection of risk, right?
Yes.
So because of those two things, because the cost of money went to zero as far as banks are concerned, financial institutions.
Which is unheard of.
Unheard of. I think it's happened like twice It happened as we recovered from the 2008 financial crisis.
Sure.
Right? Which was super real estate specific. This was not real estate specific. That was the whole subprime lending era. But between that and the Fed's commitment to buy treasury bonds and mortgage-backed securities, interest rates literally crashed. We thought it was going to go through the roof and real estate was going to like screech to a halt, and it ended up doing literally the opposite.
It did. It did the opposite. But you know what really comes to mind? So that was when interest rates were great, but then remember that May?
Yeah.
Remember that May when it felt like, I know it wasn't overnight, but it felt like overnight rates jumped up into the mid fives,
Right.
which I would love for rates to be in the mid fives right now. Isn't that so funny? But coming from where we were to then, that I did feel that strong pullback. It's like when you go on the ℏ𝑚𝓿 at Disneyland and it's the start of the ride and you're like, oh, and then it shoots you off.
Mm-hmm.
That's what it felt like for me as a realtor with the market. And I just, my heart went out to home buyers, all home buyers, but especially first-time home buyers. Their purchasing power went from this expectation to a vastly different expectation.
Overnight.
It felt like overnight, very, very rapidly. And that really had an impact. You started to see, in realtorese language, we started to see more red down arrows, when we're doing our searches, those, which just means price reductions, because what a buyer could purchase became very, very different, but their expectation was here. They did their buyer consultation. Hopefully, if they have a good realtor, they did that thorough.
I wish that was the standard.
Does not happen every time, but if they were with the right person, they did that buyer consultation. They had an expectation, and their real estate team were all on the same page of what they wanted, and then all of a sudden, they couldn't even get something close to it.
Yeah, yeah.
And what did that mean? Well, then it meant that buyers were not looking at the same things. They're having to look in a totally different price point. And there was a lot of pushback with sellers.
Yeah. Well, that happened at like a very definitive time, like from a financial market standpoint, where there was a big moment. And that's why.
Insert word.
Yeah, that's probably literally what they said, around this big round table somewhere, right?
Off
oh
camera.
boy, we may have missed the mark on this. And then that's where we saw that big jump of interest rates. And it really has to do, again, with inflation, right?
Yes.
When we started seeing signs of inflation, there became this big argument, and half the economists, you had Stanford economists on this side and Harvard economists on the other side, right? And the whole argument was, is this real inflation? Are goods and services really getting more expensive? Or is this a further product of COVID and really more about supply chain issues, right? Because,
yes.
I remember driving, my family, we drove up to Santa Barbara, just get some fresh air and walk around. And we were driving coastal, and there were shipping containers, those ships that have those big Legos on top of them.
Yeah, yeah.
Your entire ocean horizon was ship after ship after ship. And then you remember Biden came out and said, we're going to work with the unions and we're going to have people 24 hours around the clock, the longshoremen, all the people working there to get those products on the shelf. And they called that transitory inflation. So the bet was hey, this isn't real inflation. As soon as we get all those boxes unloaded,
okay.
It's all gonna, because you've talked about this before. It's about supply and demand ultimately,
yes.
right? So when there's only one roll of toilet paper on the shelf, you can charge a lot for that roll of toilet paper because people really need it.
Yeah.
But they said,
the
hey,
cost of eggs. You remember the cost of eggs and how that happened?
Eggs is always the big ticket item because we eat so many of them. I have 3 boys at home. We go through eggs. We should just buy chickens, frankly. But yeah, that was the real deal, right? The bet was on the fact that this wasn't real inflation. So they should have started incrementally raising interest rates, right? The Fed. They should have backed off the buying of mortgage-backed securities a little earlier, but they didn't, because the commitment was, this is just COVID at play. And then right before that time you're talking about was where they went, well, maybe it's not just transitory inflation. Maybe this really is inflation. And so to combat that, the Fed came in heavy-handed, right? Sometimes we wish the government would operate more like a feather, where they float down and float up. Unfortunately, it's iron hand. It's like Thor's hammer, right? Boom.
I don't think soft edges when I think government.
No, soft
I
edges.
remember those. I remember those times too. Gosh, the cost of repairs increased. Do you remember when it used to cost $35,000 to put in a pool? Really, seriously, and just the cost of, because clients are asking me, hey, I want to buy this house. And, are we looking for a house with a pool, or are we looking for a pool size lot? But then we start looking into what the cost of getting a pool would be. And then the cost of repairs increased, the cost of building homes increased. That impact the new builders. I sell a lot of new construction. I felt that as well. Everything costs more because of that supply and demand. Gas. Oh my gosh, our gas prices of where that was. Food, our dollar just didn't go as far. Adam and I have this joke. I mean, I'm only in my mid 40s, okay? I'm still a baby. But I remember when Adam and I were first dating, we loved going to get a good carne asada burrito from taco shop. And there was this taco shop up the road from where we were, and we'd go and it was like $5 for a burrito. It's $15 for a burrito now. It's just that's the real thing. But then bringing it back to, okay, looking at now even the cost to get a loan, the amount of closing costs, even the closing costs.
Yeah.
Again, my heart goes out to my first-time home buyers because they may be very well qualified, but they're getting started and they're, I don't want to be insensitive, but what we call cash poor. Very, great jobs, great income, great credit, but they need help with those closing costs and even the costs of, and I'd love for you to speak into this. There is no such thing as a 0-point loan right now.
Not anymore. Not anymore. And so that became the standard for a long time, especially when interest rates were 2.5% and 3% and 3.25%. Everybody was getting no-point loans, right? And this is why, right? If you're an investor,
and can you explain what that means?
Yeah.
Like, can we break that down?
Sure.
Yeah.
So every interest rate, like let's just give like a case study, right? Like if somebody was going out and putting 20% down to buy a home and they were getting a loan for 80% and they were going with just like a standard conventional 30-year fix, right? Like your most vanilla type of financing program that you could do. There are what we call par interest rates, which means your rate is right here today, Katherine, and that is at no cost to you, meaning you don't have to like pay to get it there. And at the same time, there's no credit to you because, believe it or not, it works both ways. So, and the reason why everybody was aiming right in the middle at no points is because it has to do with the expectation of what's going to happen to this mortgage, right?
Yes.
When lenders were doing...
From who?
From the lending institution standpoint, right?
Yeah.
Because when we were doing 3% interest rates, like these were the lowest interest rates have ever historically been, right? So what's the likelihood that borrower is going to stick in that loan? It's huge, right? Because we knew that this was just a moment of time and that interest rates were going to go back to the 5, 6, 7, and even hit 8% last November of 2023. So those loans are golden to an investor, right?
Investor confidence. So now fast forward, right? High 6.75. Recently we were at 7. We're kind of retreating back from that a little bit. So at 6.75%, but with the Fed giving us a commitment last September that said, it is time, baby. And don't forget, it took us 33 months to get here, Katherine. It's going to take us 33 months to settle down. It's not going to happen overnight.
Right. But we know over the next 2 or 3 years, interest rates are going to go down. And many of the forecasts are saying substantially. So if you're giving somebody a 6.75 loan, what is the confidence we have that they're going to keep that loan for more than a year or two?
I would not.
Of course you wouldn't,
and
right?
And even, so many lenders are saying, and there was that whole phrase, which honestly I hate, where, what did it say? Marry the house, date the rate.
Yeah. I hate that.
I hate it too. But it comes from the foundation of, okay, you're going to build equity in your home and just plan on refinancing. There's no guarantee. We don't have a crystal ball. I lost mine. But like you said, there is that confidence. There is that goal of rates coming down. So therefore that is going to impact that investor confidence.
Right. So now we have to charge up front. Right? We have to charge up front to mitigate it. Yeah. People don't realize, there is this big perception that like mortgage companies are like these like big bankers, like twirling their mustaches.
Scrooge McDuck.
Scrooge McDuck, exactly. Like
rolling around in the money in the vault.
That's not really how it works. In fact, mortgage companies have to keep loans on the books for, I think I read, like nobody makes money for the first year and a half on that. Right, because people have to get, underwriters have to get paid, production people have to get paid, staff has to get paid, bills have to get paid, right? Like there's a lot of costs that go out. So by the time these things become profitable, It takes a while. So if you don't have the confidence that this loan is going to be on the books, like you might end up losing money by doing these loans for people instead of making money.
And they're not in the business of losing money.
No, they're not in the business of losing money. So unfortunately, the net effect to buyers is that they're experiencing this upfront cost. And like, let's say it's a point, right? Just, it's just 1 point. If you're doing a $700,000
Explain what
loan,
1 point is, because not everybody knows what that means.
Right. So a point is an origination cost for your mortgage. Can be anything. It can be a 1/4 point. It can be a 1/2 of a point, 1 point. Now, a point is 1% of your loan amount. So if you're getting a $700,000 loan, that's $7,000, right?
Stressing that it's on the loan amount, not the purchase price.
That's right, on the loan amount.
Because that's often a confusion.
Definitely. So, you don't want to like over promote a customer paying too many points up front right now. Just because of like the relative confidence in the fact that a couple of years later they're going to be refinancing, but unfortunately the 1 point origination has kind of become like a standard. It's not in every single case, but it's become a standard. So, but if you look at like a first-time home buyer getting into say a $600,000 home here in Southern California, and generally the indicative trait of a first-time home buyer is like they're not coming heavy with down payment generally.
Correct.
Right? It's very hard to save money, especially with cost of living and rents in Southern California. Yeah. So typically, the amount that they're borrowing is pretty close to the sales price ultimately. So if you're buying a $600,000 house, maybe your house is $575,000 or the loan amount. So that's adding $5,000 to $6,000 on top of your closing costs.
That's a big difference.
It's huge. It's a really big difference, especially when we've been operating in a market where sellers haven't been willing to help out with that because they have so many competitive offers that aren't asking for it.
Yeah, it's interesting. I remember, so a couple of examples. So I remember David and Marissa, they're some dear friends of mine, and I helped them buy their first home. And it was towards the beginning of 2020 of, when everything went down. And house came on the market. We were in the door showing the house within an hour of it being on the MLS. And an hour later, we had an offer in. It was at asking price. And they were first-time home buyers. They were VA. They needed some help with closing costs. We asked for, I think it was $10,000 in closing costs. And we got it. And that agent actually has become a friend of mine. But a month later, that would not have happened.
Totally evaporated.
Yeah. And closing costs, my heart just broke for any of the folks that I sat down with and they needed help with closing costs. All of a sudden we were having to have, people were having to go to family members and things and get help because it just was not a thing. Then we had that change, that glorious May, as I said earlier, and we started to see a shift again. And then the whole 2-1 buy down thing came up. Even the builders started to do it. And and then it's interesting, and I'd be curious to hear what you saw, but from me, then it faded away a little bit again. But now it's come back again. Mm-hmm. I mean, I even have a seller right now where she, in the area where she is, she's a little bit more rural, and she's in this price point that's been impacted. Inventory with where she's at from January to September literally doubled because the days on market was taking longer. It's not like they had a flood of new inventory, but the active inventory doubled. And then what we were looking at in the analysis was, the high end, and definitely across the board. I mean, I have friends who sell in LA and such, and that high end market has definitely been impacted.
Yeah, no doubt.
Definitely. The high end market has been impacted. But what I saw in the analysis was the entry level, and I really see this across the board in all the areas I serve. The entry level is still moving. And at a pretty steady rate, not in the, hey, it sells in 2 days necessarily, but, I've been watching the median days on market kind of be that 12 to 14 days.
Yeah.
But that price point just below the high end also severely impacted. And so she was really kind of caught in the middle of that. So then where I'm going with this is we had to get creative. Okay, because buyers were just hesitant. They need a home more move-in ready often, or because they don't necessarily have the money. They're using all of their money for their down payment and closing costs, and they don't necessarily have the money left over to do projects, which they're taking into account.
Right.
Or they need a seller who's willing to work with them to bring that payment down by doing some sort of buy down or doing some sort of incentive so that they can save up to do those things they want to do. What are you seeing?
So I would say very similar. Like we're definitely back in that era, but like certainly I wouldn't say that it's been any sort of like pendulum shift, right? Because that would insinuate it went from like one end to the other. I think we've kind of like centered up a little bit where, look, if you're buying the shiniest house that you can just come and like hang your clothes in the closet and you're just like, there's always going to be massive demand on those
and
homes,
there's always going to be those gems too.
Right. So I had a really great recent success story for a first-time homebuyer. And you mentioned like how that first-time homebuyer market was churning like almost no matter what, whether the rate was 8 or the rate was 5, like there's still, we're moving. And look, when you look at the cost of renting, right? If you're a family and like a 2-bedroom apartment's not going to cut it, right? Like you have to go rent a single family residence. What you're paying for that home, plus rental insurance, plus utilities, plus not getting any taxable advantage of doing that, right? People are kind of shocked when they see the numbers to the numbers. It's not that much more expensive to get into a home as a homeowner than
and to invest in yourself instead of someone else.
That's right. It's like a forced savings account, right? When you leave that apartment or that house as a renter, you say bye-bye. The equity earned by paying those mortgage payments over that 2, 3, 4, 5 years that you've lived there, you don't walk away with that. The seller maintains that. That's why you always say, hey, you know, people don't get rich by selling real estate. They get rich by never selling real estate, right? Become a landlord, have a renter pay for your mortgage payment. And that's very real.
Yeah.
Right? Even if you're not making a lot of money every month, they're paying down the mortgage and you're experiencing the growth in equity. So there's a lot of money to be made. So a lot of first-time home buyers realize that the only way they're going to get to their second home is by getting into the first one. And it's a sacrifice.
Oh my gosh, it's so true. And I think a lot of conversations I've had lately are just get your foot in the door. Because I think there is, and Daniel and I were talking about this too, you know, because his generation, they see, and honestly, I think even our generation have fallen into this trap of we see where our parents are living, we see where they're at right now, and we think that's where we have to be right now. But no, what I like to call it is a stepping stone home. Not that our goal is we want you to love where you are. We want you to love where you live, and we want it to be a blessing to you. But to get your foot in the door in real estate is huge, because that first place, okay, maybe you're buying a condo instead of a house. But that, but that first one is going to build that equity, and that's going to allow you to get the next one. And then the next one. And it's just this snowball effect in such a positive way. And before you know it, you've got Olaf. You know what I mean? Like
when you said that, it reminded me of a story. So let's see, it was like 22 years ago, I bought my first place.
Okay.
Out of college. A couple years later, me and a college buddy, we bought a condo in Anaheim Hills.
Wow. And Can you think what that thing's worth now?
Oh my gosh, outrageous, right? And I remember being into that and like, just this concept. I wasn't in the business yet, right? So this concept of being like on the hook for 30 years at this big payment. And I was like, oh my gosh, this is crazy. And like so many times, as I'm like eating top ramen and 99-cent menus every day just to like eat, I'm like,
yeah, right. You did anyway.
I know I did, but I had to ask myself. There was many an evening where I'm like, gosh, was this worth it? Is it worth the sacrifice? Yeah. I asked myself that question right up till the day we sold that condo, right? And I walked into my next home that I purchased with a big down payment that I said, what would have been my other mechanism to save this money? There is not lottery. Nope. I don't know. I'm not a gambler, so Vegas isn't the answer for me, right? And I just and from then it just started a love affair with real estate, and I've bought 5 homes since then. And it's funny because a lot of people, is this the right time to buy? Is it not the right time to buy? It's like the only day that really matters is the day you have to sell your house. If you keep the house long enough, you're always going to end up.
It's true. Okay, so from a financial standpoint, where do we stand today?
Yeah.
And what can people expect if they believe homeownership is for them?
Yeah, that's a good question. So interest rates, in September, the Federal Reserve came out with a very definitive declaration that said, like figuratively in your mind, right? This mountain that we've climbed over the last 30 months of them hitting us with the biggest increases of rates that historically we've ever seen. We're done. We've reached where we planted the flag on top of Everest, right? We made it. The Sherpas carried us to the top. We made it. And that now it was time to start easing up, because although they said this is necessary and we're going to do it for as long as we need to, they said the number one thing that we have to be aware of is not causing even one day of extra pain on the backs of Americans than is absolutely necessary. And we're starting to see the data in the market with a softening jobs market, with the preposition. In fact, our last month's job numbers of new jobs was 12,000, and it was forecasted to be over 150,000. Right? So something happened there, right? And the Fed said, "Okay, it's time to start coming down." And upon that, they didn't just say it in words. In that same Fed meeting, they actually reduced interest rates by 0.5 point or 50 basis points, which was the first time we have gone down in over 33 months.
Yay.
It's a big sentiment, right? Now, so what does that mean? Rates will get better moving forward. Now, there are some things that are, really hyper focused on, like this election that we just had, that have caused like a kind of a temporary bump in interest rates. So we're close to like 5.5 to 5. Oh, I'm sorry, 6.5. I wish it was 5. That's just willful thinking.
Yes, we're speaking it. We're speaking it out.
Yeah, in that 6.5 to 6.75% range. Government loans, or people that are like getting in with like FHA loans, lower down payment, more first-time homebuyer programs, a little bit lower, like down near the 6% range. So, Katherine, we were at 8% last November.
Buddy.
So people that say, I'm going to wait till they get better, they got better, like big time, by a lot, almost 2 points.
And I think the big picture thinking too is also for those, not for our first time home buyers, but for those who maybe are in their home and they have that 3% or the 2.75% from that refi that they did or whatever, but they still want to make a move, but they feel stuck, because they feel there's this emotional thing of, how do I let that go? But just kind of flipping the switch a little bit and recognizing how much equity they've built, kind of like your story of the first place that you bought, and using that equity to do that next step, to go to that next stepping stone.
So you mentioned a minute ago, like you're seeing inventory improving.
Yes.
Right? That's pretty safe to say?
It's still lower than pre-pandemic levels, but yes.
Right. So if I'm a seller, right, and I'm kind of paralyzed with that 3% interest rate, right? Some of it is I think like, the mental attachment to the number, but some of them, like I've reviewed situations for some sellers who are like, Dave, you're telling me I'm going to go buy a cheaper house and my mortgage payment's going to go up?
Does not make sense.
Doesn't make sense.
Nope.
Right? They truly become like chained to that house. Well, I think what part of the reason we're starting to see this inventory hitting the market is this sort of like declarative statement that we have better times ahead of us. 2 years out, 3 years, like I said, it took us 33 months to get here. It's going to take us 33 months to get down. But I think a lot of sellers are saying, hey, look, life has to move on. I have a wonderful couple that I put into a condo. They had a little boy. At the time, I can't remember how old he was, and then a little baby girl, I remember holding the girl at the closing table. It was like amazing, right? And they've lived very wonderfully in this 2-bedroom condo. It's what they could afford at the time, right?
Sure.
They made the sacrifice to do it. And so he called me, and I mean, this was 10 years ago.
Okay.
When we did this. And now he's like, Dave, we got to move. Oh, really? But the mortgage payment, though, we refinanced him into a 2-point-something, during COVID.
But they're bursting at the seams.
Well, not only that, like it's kind of gotten inappropriate, right? Now they have like a
13-year-old
boy sharing a room with like a 9-year-old. So they moved the boy, into basically like the family room. So it's not like life has to move on. People want to
Yes.
leave California. People want to come to California. Like, I think at this point now, people are like, okay, it's time to let life be the predominant driver of what we do. Plus, we know that if we can get into the house now, then we have an opportunity, more than likely, of refinancing in the future. So it kind of only gets better from there.
Yeah, I mean, almost like taking advantage now and before prices, even though prices are only anticipated to increase, in that lower amount, it's still more. But so getting in now and then refinancing when it's, the right time, and
That's
then
right.
taking advantage of that.
Also an advantage for home buyers today that are not selling a house, right? It's
very much so.
It's securing the house price right now, because many people say, oh, wait till interest rates go down a point. Well, what do you think is going to happen to prices if money gets a point cheaper?
Exactly.
They go up.
So this all leads into, when is the right time? And that's another conversation I'd love to have with you, is when is the right time to buy or to sell or to do both? I would love for you to have that conversation with me on the next one. Are you willing to do that with me?
For sure. It's the question of the day, for sure.
Okay. Well, they better make sure that they tune in for that one.
Let's do it.
Okay.